Santanu Sengupta, Chief India Economist at Goldman Sachs, who joins in on the show now. Santanu, good morning, and always great to have you on the show. You have an interesting take on what I think a lot of commentators have been celebrating with the GST rationalization, the income tax relief which was given in Feb as well. You're looking at it from the lens of fiscal slippages. How worried are you? I think you're on mute, Santanu.
Thank you. We think that the worries on the fiscal front are overdone. Our sense is that you'll be losing some revenues on the income taxes cut around 20 to 30 basis points of GDP. There'll be a further 10 basis points odd slippage from the GST rate rationalization. But our sense is actually the government will stick to the fiscal consolidation path, which means that some other expenditure, including capital expenditure, will have to bear the brunt or take that hit. And therefore, from a top-down perspective, we think that this cycle is very positive for consumption, whereas Capex, especially from the government side, will be taking a slight hit. And therefore, we are waiting for the private Capex cycle to kick back in once the tariff-related headwinds are over. So on aggregate, I would say slight bit of fiscal concern. From the market side, we think it is overdone. We think that the government is going to stick to 4.4% of GDP, and we favor consumption, especially the mass consumption category.
Santanu, sorry, just to understand this, sorry, because I heard you say that fiscal concerns, did I hear you say that the fiscal concerns are, I mean, for lack of a better word, overblown or exaggerated or something like that? Did I hear you say that? Because I was reading your note wherein, I mean, it is of course 5th September, but it mentioned that fiscal risks have risen. So I was just trying to understand if things have changed between then and now.
So from the market's perspective, the fiscal risks have risen.
Okay.
And therefore, you've seen the back-end steepening of the curve. So anywhere between the 10-year to the 30-year point of the curve has now risen in terms of yields. Okay. We think that is overdone. We think that the government is, there's no concern in terms of the government sticking to the consolidation path. We think that the government is going to stick to the 4.4% of GDP fiscal consolidation target. And therefore, what that is going to mean is some expenditure reallocation or cuts elsewhere. Most likely, some bit of it will have to be borne by capital expenditure and some expenditure cuts elsewhere to stick to the consolidation target. But the fiscal risk in terms of the higher issuances, we think is overdone.
Got it. Okay. We also want to invoke the JP Morgan bond cutting piece in the conversation, but just a follow-up to your answer, Santanu. Now, I'm requesting you to, as you would normally do, right, take maybe an 18-month or a 30-month view, right? Because the government is anchored on fisc numbers, the fiscal consolidation, and we know that that's probably a certainty. So this year, until the spends come back, maybe the cuts happen on the Capex side. But if you take an 18-month view, could the government be able to balance out the troika of fisc consolidation, revenues, as well as spend on consumption and Capex? Could all three coexist well if you take an 18-month view?
We think on the consumption front, all of this is very good. I mean, first the income tax cut, now the GST cut. You've already seen some transfers happening at the state government levels, targeting women and lower income households. Plus, you have a very organic growth cycle in the agriculture front, right? I mean, you have great production this year, food inflation is lower, and real wages are higher. As you head into next year, we think that private Capex will have to come in a bigger way compared to the government. The government will still be spending on Capex, most likely in line with GDP growth rate, nominal GDP growth rate, or slightly lower, because you're sort of holding the Capex spend as a percentage of GDP, or maybe shaving 10 or 20 basis points. But the main heavy lifting in terms of capital expenditure going forward, if I'm looking at the next 18 to 24 months, will have to be done more by the private sector, in our view.
I'm just wondering, Santanu, do you see it play out positively for the consumer staples, consumer discretionary space in a very real way? Because the cause and effect are not really matching up. when you see what's happening to some of the larger companies. Do you think that there is a bit of a chain that is broken there, or how do you see it pan out, where you have a boost in consumption, but where does that extra money go?
So we think that until now you are having a boost both through the agricultural cycle and through the GST rate cuts, especially at the very bottom end of the mass consumer goods. This was a boost for staples. But now we've also learned on the GST side that some discretionary items rates are coming off, and therefore we are positive on the layer above the very mass consumer space as well. I mean, namely autos, for instance. So overall, we think that this is pretty positive for consumption. If you put everything together from the start of the year, income tax cuts, part of it could have been used for deleveraging, but the rest of it is getting spent and coming back into consumption. Then the agricultural cycle, which is very organic and had nothing to do with sort of fiscal or monetary support in any way. Now you have the GST rate cuts. You've had 100 basis points of easing already from the RBI. We think there's one more to go. You're having the CRR cuts come through. All of this coming together, we think is going to be positive for consumption. Actually, on the staples front, you've seen volume growth slightly recover already in the previous quarter. In this quarter, it's going to be a bit of a challenge because the GST cuts have been announced and there might be a delay in purchases. But in the next quarter, that is in the October to December quarter, we would expect this recovery to really pan out.
Shantanu, in fact, we were just discussing with regards to where JP Morgan goes now, what they've done is they've reduced their weightage with regards to India and China in terms of their bond index. Firstly, what is the kind of impact are you seeing from an overall perspective on the bond market, specifically when you have to look at India?
Yeah, so on the bond markets, I would say, as I said earlier, the curve is quite steep. The 10 to 30-year point, especially at the very long end of the curve, is quite steep. Our sense is that if the government is going to stick to the consolidation path and you're not going to have incremental issuances, the flow of savings in that segment is quite significant. And therefore, from a macro standpoint, we like the back end of the curve. Another way to put it is that we think that yields are going to come down in the very long end of the curve. You've seen a bunch up in issuances also, both from the state and the central government side, in the first half of the fiscal year. And therefore, we think that that is going to come off again in the second half. All of that put together, we think that yields are headed lower if we look at this like 3 to 6 months out, especially in the long end. The JP Morgan move is going to be a fraction in terms of the overall flow that you've seen. You've seen a significant amount of inflows in the previous couple of years when the bond index inclusion happened. You're going to see somewhere in the region of $2 to $3 billion of outflows just because of this reallocation. But again, as this happens, remember, from an active management point of view, some of the valuations in the long end of the curve is quite attractive, and therefore we would expect some flows to come back in the very long end.
So that's the kind of impact that you're seeing, but it is very steep right now. What happens from here on is going to be interesting because you have the GST rate cuts that are coming in, the impact with regards to the government's revenue collection and in turn the fiscal deficit. But thank you so much, Shantanu, for joining us on the show and sharing your views.